Hey everyone, hopefully you're having a good question. Hopefully you're having a good question is what I was going to say. I've got a question behind me, but hopefully you're having a good day. My name's Andy. My channel is Finding Value. I've got a question here that was sent to me. It's about the thesis of the channel, and I'm going to answer it to the best of my knowledge. Let me read the question real quick and then I'll answer it. It says, the question I have relates to our central thesis of the channel and a potential challenge for the thesis. Given our engineering background, we like to identify potential problems before they occur. Our thesis is a continuing increase in housing starts in the setting of inflation and increasing demand. Well, the thesis is the volume of loans against the volume of loans against the increase in housing starts is inflationary, period. So that is the thesis. The thesis is the greater the loaning volume, the more inflation you get because the majority of bank loans in a commercial bank lending system is against residential real estate. Therefore, that the majority of inflation comes from the loaning in a fraction reserve lending system against those residential homes. It says, additionally, there's limited supply of housing available. It has been stated on our channel that we don't see a way for housing supply to increase dramatically. So the thesis is right irrespective. What you're arguing there is where we are at within the cycle. So everyone's debating on where we are in the housing cycle. Are we at the top of the expansion phase, or are we entering a hyper supply phase? It says, we don't see a way for the housing supply to increase dramatically. I wanted to get your thoughts on a possible scenario which could cause a rapid increase in supply and possibly cause a crash in the real estate market. So you're challenging where we are at in the real estate cycle. So the Federal Reserve has $2 trillion in mortgage-backed securities. The Federal Reserve has said that they are going to start quantitative tightening. If they start reducing their balance sheets by selling these probably less than AA-rated MBS, this could cause defaults and foreclosures, which could increase the amount of homes available. So, number one, I never play in the game of what ifs in a market that moves as slow as the real estate market. The market moves too slow for me to play the what if game. Also, the mortgage-backed securities, if you were to look at what those are, it says the Fed targeting agency MBS because the loans underlying the securities make up the majority of the market for housing. By buying into that market, it's able to create a huge source of demand for those bonds, pushing down yields and rates. If these people own fixed rate mortgages, which the majority, almost all of them do, you're not going to have problems with foreclosures. Their payments aren't going to change. What you are changing is future payments or the rate that future people who are going to loan against. So I don't see this as a problem. My rate, my 30-year fixed rate mortgage that I took out a couple years ago when I refinanced isn't going to change irrespective of what the Fed does with buying mortgage-backed securities, but it will impact the yields or rates that new people lock in for their mortgages. So I don't think that you're going to see defaults or foreclosures because no one's on adjustable rates like they were in the mid to late 2000s. It says interest rates are going up, inflation is increasing. Both increases are challenging for the stock market, and many predict a bear market recession in the stock market. There are several hedge funds who have bought up large numbers of single-family homes. Some of these hedge funds have very many homes which they own. For instance, Blackstone hedge fund has many homes. Blackstone hedge fund also likely has significant exposure to the stock market and is likely significantly leveraged in the stock market. If there was a significant fall in the stock market in the setting of quantitative tightening by the Federal Reserve, the selling of mortgage-backed securities by the Federal Reserve, rising interest rates, and rising inflation, then hedge funds may need to cover their stock market exposure by having to sell all or most of their single-family homes. This could produce a rapid increase in the supply of single-family homes. Well, it depends how you look at it. I think what they're doing is they're selling their bonds because you have an increasing interest rate environment. them selling those bonds is increasing the interest rates. They themselves are the root cause of the interest rates going up because they're selling their bonds and they have to put that money somewhere. Where are they going to put it? Where are they going to put their money? They're going to put it in real estate because they have nowhere else to put it. They can't pile into commodities. It's too small of a market. They can't pile into precious metals if a lot of these guys are part of the banks. And if you pile into precious metals, it'll show that the problem exists in the markets. It'll show that inflation is real. So they don't want that. So they're probably forced to invest into real estate. And if those homes come online, we have millions of buyers that are priced out of the market right now. So I don't think the market could fall substantially because you have this gigantic amount of buyers all underneath the market holding the whole thing up. At least that's my take on it. It says, I do not feel this scenario is likely to happen, but if it did, do you think it would have an effect the housing starts and the real estate cycle? Do you think it would negatively impact our thesis for the channel? Do you agree that the expected commodities bull market would remain intact? I don't think that this is enough to basically bring down the housing market. So what I think is needed is we need to build a lot more homes irrespective. That's why everything is going up. Rent prices, home prices, everything. Now, what's going to happen is you're going to probably get increased competition to buy these homes. Why? Because you're going to get people that have to rotate money out of bonds if interest rates go up high enough and fast enough. They're going to get money out of bonds, and they're going to say, where do I put the money? And that includes individuals, it includes hedge funds, it includes large amounts of money. And the money has to go somewhere. Where is it going to go? If let's say I make 10 or $20 million, all right, and I've got 20 million, what am I going to do with it? Well, I'm going to go buy another house. A house is something that people need. It isn't necessarily something that they cut back. So what I think is going to happen is they're going to cut back on everything else. They're going to cut back on Starbucks. They're going to cut back on Netflix. They're going to cut back on all the stuff that they don't need. Then what they're going to do is they're going to aim all that money and try to buy a house. Because if your rent prices are going up 50% year over year, well, better get in a house, lock in those rates, lock in that price. And if there's a shortage of homes, the home prices are going to continue to go up. So I'm a bull because of the demographics. What everyone is debating here is all financial type driven stuff. Your demand is so large that we have to price it all out of the market. And with interest rates, it may or may not price some of those people out of the market. The question then becomes, when interest rates go up, are you pricing the people that can currently afford it in the market? Are you pricing them out? Or are you pricing the people who are already getting priced out? Because there's a gigantic amount of people that are already getting priced out of the market based off of prices and how much people are bidding up over the asking price. Some of these people have to produce cold, hard cash when they buy that house, and depending on what the appraiser gives it. And I don't understand that whole thing because the market is determining what the price is. The appraiser is just making money for no apparent reason. They're just going to say, okay, yeah, this is fine, write it off. They're just trying to make sure that you don't have a fraudulent loan against something that's larger than the house is worth. But I don't think we're not there yet. We don't have any inventory. In order to have a bubble, your inventory has to increase. And if these were to have an impact, we would see it in the inventory. The inventory is like 4 million homes short from where a bubble could potentially be. So that means that we could increase this by 4 million homes and still, I would say, it would still be intact, the overall market. That's where I think we'd be at a tipping point. 4 million homes, we're not there. There's no way you're going to get that many foreclosures. You could put the whole forbearance on. It's only like 2 million. And I don't even know if the market would go down if we put all of them on in one shot. Like it's short that many homes, and we have that large of an imbalance in the demographics of supply and demand. So that is our trend setter. I think that this trend's going to remain intact until we build a lot more homes. That's what we've seen in history, and this is irrespective of interest rates. Interest rates went way up in the 70s, way high, and affordability went way down. But I mean, we'll see how that impacts. We can watch inventory, and it's slow moving, so there's not really a huge risk in terms of things going bad. And I know a lot of people, they're looking at the pricing of things, and yeah, we could have a pullback, but a pullback doesn't mean that the trend is done. A pullback is just a pullback within a move higher, which you'll get irrespective. You get that in the market every time you go up. There's pullbacks. There's consolidation periods. So I don't think that this has a problem at this time. If I saw inventory up around 6-8 months, like 8 months, if it was up around 8 months, then I'd say, okay, we're getting up there. We're getting up there, and all of your worries are probably grounded in some good data, because the inventory is up around 8 months, but we're at inventory of 2 months, and we have no homes to sell that are new. I mean, there's like nothing to sell right now. So I'm going to take the exact opposite bet and say that house prices probably are going to go up at the fastest pace we've ever seen, because our inventories are the lowest they've ever been. And that's exactly what prices are doing. They're starting to accelerate to the upside. When will this stop acceleration, or accelerating as fast as it is? I don't know. We have to watch it. We have to watch and see what it does. And this stuff moves so slow, you don't have to make predictions. You just, you watch it, you watch your inventories, you watch your prices, you watch your days on the market. If things start to slow down in inventory, when the days on the market start to extend out, and your inventories come to a level that's maybe like 6 to 8 months, then we have a trend of a weakening market. But we're on the opposite end of that. We are getting tighter and tighter, and days are getting shorter. And we have to see if the mortgage interest rates have an impact on it. All the financial type guys are saying that this is a bubble. All of the real estate people say it's not a bubble. I'm on the real estate side. I'm not by all. I have no relationship to real estate at all. I'm an engineer by trade. And when I look at the numbers and I do calculations, or I look at it from what I think is a logical perspective, I can't come up with a housing bubble. We are not within a couple of years of a housing bubble yet. And when we're talking about putting on homes, you need 4 million homes for like bubble territory. I just don't think we have that much in the pipeline that people are just going to dump on all at once. I don't think it's there. So that's my take on it. And it's important to challenge this, because this is what's providing the market conditions and tailwinds behind our investments. If the housing market is strong, we are going to maintain that tailwind, and I think our investments will continue to rotate money over from bonds and stocks into our investments. And I've talked about this before. The stock market's going to drag us and pull us with it sometimes. And I don't necessarily know what that's going to look like in its entirety, and I don't think anyone does, because what you're going to happen is when things sell off, sometimes they just do indiscriminate selling. They sell everything, and then it pulls us lower. But that would just create a buying opportunity. And to time this with an entire YouTube channel would be, it'd be ludicrous to try to time these things. It's very stressful. I tried doing it last time, and I was not successful at doing it. The answer isn't necessarily to become a better trader or swing trader. The answer is to, the gains are so large, it's better just to hold on and cost average in on dips. Buy the dips, hold the rips. So that's been my strategy, and that's been my paradigm. And I think that's the easiest strategy to follow, especially if you're not a professional trader. And most professional traders don't do as well as you think. I don't know many professional traders that made 25 times their money in a single year. And that's what I had done with a couple of my companies, just holding on and not doing anything. We bought at very low and cheap opportunities and held on. And there's other 10 baggers and whatnot. And I'm lucky that I participated in that. I'm glad I am. There's going to be more 10 baggers, but in order to do this, you got to ride through it. And that's the important thing, is focus on this. This is the market conditions. This is the tailwinds. make sure you're accurately looking at the data. Now, you mentioned Michael Pinto, and some of these guys, they get it wrong a lot. And I'm not saying necessarily him, but a lot of these perceived financial experts are not financial experts. They are not good with the housing market. And I learned that the hard way watching them the last bull market. Peter Schiff's not a good housing expert. Mike Maloney's not a good housing expert. These guys are not good housing experts. I just took it on myself and started researching it myself, and it's pretty easy to follow it. This doesn't take a genius to follow, and I don't know why they can't get it right. I have no idea why. They keep saying bubble, bubble, bubble. I just look at the inventory levels and say, you're wrong. You are wrong. These people are wrong. If you're in the bubble camp, they are wrong at this time. And when you're calling a bubble, that means that you are within a few months of the top. If you can call it within a few months of the top, kudos to you, but we're not a couple months from the top. We're probably years away. And why do I say that? Because the inventory doesn't move that fast. You need 4 million homes before a bubble comes. Where are the 4 million homes going to come from? You answer that question if you know where the 4 million homes plus is going to come from, because that's 4 million without buyers. We've got buttloads of buyers. So it's 4 million on top of all the buyers that we have out there that are willing to purchase homes if they're available. So maybe it's 10 million homes. Where are the 10 million homes going to come from if we don't build them? Where is this 10 million? The entire market giving out bad loans last time was probably 6, 7, 8, 9, 10 million homes. The entire bubble of last mid-2000s of all these bad loans and all these people doing stuff that was horrible. Do we have that amount in the system that's ready to come back on? I don't think so. I don't even think we have. We may have maybe a third of that at best, probably even less than that, probably a fourth at best. I don't think the homes are out there to have this crash. That's my opinion. But let's monitor the inventory. Let's watch and see what it does. And if we start to see inventories increase in a trending fashion above 6 months, then I will change my opinion. It's that simple. All right, guys. If you like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And check out my website. Platinum membership gets you all the goodies. It gets you my favorite sectors, favorite companies, and you get to see what I'm buying. And I usually give 2 videos, one in the beginning of the week, one in the middle of the week, of what I'm doing, if I'm doing anything, and or companies that I would be buying if I had money to deploy into, or if I was underweight those sectors. If that sounds interesting to you for this next commodity bull market, definitely sign up, join us. It's a family over there now. We do weekly get-togethers on question and answers, and I answer all of your guys' questions with my opinions. And I obviously have a very different viewpoint than a lot of people in the market, apparently. And I think that, obviously, I think my viewpoint's right, but that's why I have it as my viewpoint. But I think some people they think that the real estate market moves much faster than what it actually does. That's what I think the biggest difference is. But we'll see you next time, guys. This is Finding Value.